What's up, outliers? You know what time it is. It's time to get back to the basics. It's time to look at some fundamental trading concepts so that we can all dust off our skill sets and hopefully make a few dollars out there in the markets. We'll see how it goes. Who knows? Nobody ever knows. So we have a bit of an open agenda for today, although there's a couple things that I do want to hit on. The first thing is some just kind of poking through the markets and doing a little bit of a recap from a practitioner standpoint. I think talking a little bit about some observations will likely be useful. I also want to cover poking through Reddit just a little bit and using that as a vector to take a look at what a lot of basic concepts being looked at are and things like that. So we have a bunch of things to talk about. So let's start with recapping the markets. And so for the week, we obviously saw a pretty massive turn underway. We saw tech really starting to accelerate to the downside. We saw bonds starting to tick up, flight to equity. Then we start to see IWM, small caps rotating over, Qs rotating over, and even the SPY now starting to rotate over. So really, this is becoming a generally broad market movement that we're seeing. Obviously, we are at the point now where this clearly is in, at least at this point, a correction, if not starting to migrate even towards a bear market. Not quite there, talking about Qs specifically, by the way. IWM still hovering right around a correction, and then SPY is not quite there yet. SPY is the last bastion of strength that to me is slowly looking like it is rotating over. So for NASDAQ, I see net highs lows negative with gross lows expanding, and I see net highs lows across the New York Stock Exchange contracting massively. Yesterday, it was at like 141 net, and today it's 47, and gross lows is expanding. So market breadth doesn't look great here. So the reason why I'm taking a minute to go over this with you all from, again, a market practitioner standpoint is because making observations in the market is part of our job as traders. It's what we do. It's how we identify things that look interesting to us that we want to explore, ideally trade. It's how we make money, by identifying things that look good. So understanding the broad market, in my perspective, is a really important part of this process. I actually have, let me find it, in the handy dandy notebook of all things options trading. This thing, as I've mentioned a few times, is starting to get a little unwieldy, but I'll show you. Let me see, maybe this one. Yep. So this is actually going to come out in a video soon, but this idea of like starting from the top and zooming into the individual products is a really useful process. So that's a quick recap of the markets. We'll dive more into it, but as you know, we got to grab the chat and we got to say hello to everybody. We got to see who's hanging out. And I also realize I have to turn the air conditioning on in my, well, up. It's already on. I have to turn it up in the office because even though your boy's in a tank top, it is pretty freaking warm here in Southern California. So, who do we got? I see we got Threshold Solutions. That's a really cool name. That sounds almost like somebody that clears rooms, because we would call a door during CQB, we would call that a threshold. So sounds like somebody that's really good at clearing rooms. Maybe that's the case. We got Liz hanging out. We got Night Harm, Joe Tato. Why not? Roaring Titty, everybody. We got to give a shout out to Roaring Titty as one of the greatest names on here. Sweet made the stream. I get confused which stream is which because the thumbnails all look so similar and so many are scheduled ahead. What do you mean? I purposely go, damn it, Roaring Titty. I purposely go through the effort of even bothering with different thumbnails and different titles. And you get confused which one's which? I'm out here busting my ass all day trying to make a nice home-cooked stock market dinner, and then you got to tell me it all tastes the same. This is unbelievable. This is literally unbelievable. We also have Dr. Zayas, Vladimir off Putin. Vladimir says, I sure wouldn't be shocked to see all after Fed cuts and election uncertainty is resolved. To see all after Fed? To see all green after Fed. Okay, sorry. We needed that correction there. Vladimir off Putin. That made way more sense now. Yeah. So I actually think that this idea of a soft landing is starting to look increasingly tenuous. That's my take, because the market is very good at forecasting. And when we look across even the economic picture from the past week, things aren't necessarily looking, great, right? So if we look at PMI from earlier in the week, manufacturing PMI, that came in a little bit light. Manufacturing prices came in a little bit high. That's not necessarily ideal. Job openings still came in a little bit light, which I don't really know anymore how the market's going to interpret that news. Obviously, the market didn't like most of what we saw this week. Services PMI came in a little bit higher, which I imagine bodes well. And then, as I look across the broader market from the past week, there's a ton of stuff that happened, but there was one thing that remained the same. The market essentially sold off the entire week. Yeah, literally the entire week. Roaring Titty says, I'm not hating. I know you spend a lot of time on all this. It's just my way of brain processing. Oh, yeah, no, obviously. I'm 100% joking, Roaring Titty. There's with a name, with a handle like yours, essentially you could do no wrong in my eyes. So yeah, you could pretty much insult me directly and I still wouldn't care because I like the name too much. Completely joking. And I mean that you're not wrong, right? Like a lot of the branding is very similar. That's obviously on purpose so that people know when they're looking at something of me versus something else, which I have to be honest, there was a hilarious comment that I got not too long ago from somebody. I did a video this past week. One of them was about something regarding Roaring Kitty. So I used him in the thumbnail and somebody was really pissed about that. They literally said that he should sue me because I used his picture and they thought that the video was going to be his, which bless their heart. That's what I have to say. Just bless their heart. Carlos says you ruined the stock market dinner. Yeah, that's it. The family's fighting now. Vladimir off Putin says in January we would probably look back and now and think, why didn't I pounce? I don't know. I certainly don't feel that way. But if you're an investor and you're really gun shy at entering into the market, sure, I could see that. But if you're a trader, that's absolutely not how you look at the world, right? Because there's still several months before the end of the year. So the idea of not doing anything into the end of the year because of being gun shy, yeah, that's a problem. But from a trader's perspective, the last thing I'm doing is loading up on a bunch of long beta weighted deltas to the market, to the broad market, and just going to hold them into next year until they start to turn. That I think is a bit of a problem, right? Because there's an opportunity cost to that capital. And to me, it's sunk, well, not a sunk cost, but the opportunity cost there is enough that I wouldn't just park money waiting. Now, if you're an investor, nothing wrong with that. That's completely fine. For a longer term perspective, that's the name of the game of investing, is maintaining long-term exposure to ride out the bumps and whatnot. So Zachariah just made it in. What up? Reese is here as well. Cedar Savage says, time to pull out bearish strats for a few weeks. Yes, I actually think, Cedar Savage, you're behind the ball, to be honest. I don't think you're wrong, but I think one of the problem is, depending on what you're trying to trade, if you're just now starting offering short deltas, it's still not too late, I would argue, but they become higher risk entries. And I've talked about this most of the week. So for example, if I look across something like XLE, I've already had fades in XLE after it started breaking out below this level. I actually added more today. And that's actually one of the things I want to review today. Is I thought one of the things we could do in the beginning of the video is actually take a look at some sample trades, and we can kind of reason through them together. So there's 2 time frames I want to use. I want to use today. So as if we're trying to find a trade to put into a hypothetical portfolio today, I want to do that process. And then the other process I want to do is go back in time and on demand if it works, and see what kind of trade we would structure based on the information we have available. So yeah, that's one of the things I want to take a look at today. But first, let's start with some simple stuff. I want to take a stroll through options, the subreddit, and I just want to use this as a way for us to test some different ideas. So, and in case you guys didn't know, for anybody that's wondering what's going on with Vladimir off Putin, is he says he has half the chat blocked from a week ago. So I just want to let half of you know that Vladimir off Putin thinks you ain't shit, is essentially what I saw. So yeah, anyways, just wanted to relay that message, you know, directly from Vladimir off Putin to the rest of the chat. I'm just the middleman here. I can just see it all, but he's just letting you know his thoughts. But anyways, let's Carlos goes, that's very off Putin of you. I mean, it's on brand. You got to you got to give credit where credit's due, and credit is due there. I think that's right on point. All right, so let's take a look through some of these. I literally haven't read through them yet. Literally right before I started this, I ran through and I opened a few of them that I think would be good to cover. So this one says, bank manager convinced me options are for fools. Let's see what they have to say. Now, again, the whole point of this segment, and just in case you're new to this, what I'm doing is I use Reddit, the options subreddit, as a proxy for beginners. I can see and understand how beginners are looking at the market by going to this Reddit. So why we go through this together is to take a look at other beginner concepts, theories, things that they're trying to grapple with, because this is a series for beginners. So I use it as a proxy. That's why we go through these. And I think there's value in talking about them together, which is the goal. So this person says, went in looking for payments, cross-border. I don't care about any of this. So I traveled. Jesus, where's the fucking... Okay, so the conversation went towards trading. He's up like 50% and I'm down for the year on my options portfolio. My stock portfolio is positive and fluctuates between beating the market 5% to underperforming. On average, much more profitable stock trader, profitable trading options, get greedy. Yeah, see, I hate this. I hate this so much. So one of the reasons why I hate this so much is because when I see traders saying things like, I get greedy, it tells me a lot about their understanding of their business. And before we get too far, a quick cheers to you all with my mango orange and then a handful of drugs. So we got to get that acetaminophen down to, you know, keep functioning. Down in the hat. Nothing like some Tylenol. Really takes the edge off. But so first off, for you guys that are in the chat, especially anybody that's been around the community for a little while longer, why do I not like this? Any ideas? Why do I call out the idea? It's just that I get greedy. Talk to me. Why would I not like that? And let's get past the superficial responses of getting greedy is bad. And yeah, of course. Okay, so Kevin and Jotato are hitting on one of the things I specifically want to highlight is no plan. Cedar is actually, it looks like we disconnected. Stand by. Am I still here? It says reconnection successful. I have no idea. Am I currently Knock, knock, knock. Can you hear this? Okay, good. You guys can hear it. Thanks. OBS just told me it popped off for some reason. I actually have literally no clue. Maybe somebody's doxing me or something. I don't even know what that means. I'm not even gonna lie. All right, so let's see. The first one is the definitely no plan, right? The prospect of being greedy during an options trade or really any trade, it tells us right from the jump that you're not following something that makes sense. And I'll show you exactly why that's the case in a few minutes. So no plan is a big part. There's a really, really, really important specific thing though that I want to highlight from this. And Cedar says not mechanical. It's not that. I'm actually a highly discretionary trader. I'm not mechanical. There are absolutely bounds to what I do. But I actually personally believe that a vast majority of the edge for retail traders is discretion. If you're too mechanical as a retail trader, that essentially means whatever you're doing should just be automated. And there's a reason why most of us don't automate everything. And it's because there's not buckets of edge laying around like that, unfortunately. So that's not to suggest you can't automate anything. Of course you can. But there is a lot of value in being a good discretionary trader. The reason why the idea of being mechanical as a trader is so well touted is because it sounds super smart, right? You can't trust the trader, so then just make it a repeatable strategy that you follow these specific rules, and then you take the trader out of the equation, essentially. Well, guess who creates the edge in trading? It's the trader. So there's lots of ways to do that. And again, I would never say like, oh, being mechanical is dumb or not. Like I would never say anything like that. But that's just the reason why I'm discretional in my trading. So just an important note there. So the plan is part of it. And then Roaring Titty and Joe Tato are on the next part of it. I'll get to the part I want to highlight first, and then we'll get into those. Because for Roaring Titty, I completely agree. So for Roaring Titty and Joe Tato, not setting a stop can help with this exact thing. So let's talk about that really quick. Let's say that we're trading stock XYZ. This one we'll talk about a little bit later because I have a position on actually in this to the downside. This was going to be an example of finding short deltas. That's like a current state example, but we'll get to that in a second. Let's take a look at Palantir. They joined the S&P 500 today. That just jumped in my mind. So let's say we're trading Palantir to the upside. We think it's going to go up. Sick. Great thesis. Makes total sense. Let's say that you got in here and you're like, okay, I'm going to ride this up to whatever my profit target is. And it's going up, it's going up, it's going up. And then you're like, oh, I want it to go up higher. I want it to go up higher. And then it goes down, down, down. And then let's say you're like, okay, well, I'm going to add more here because I like their earnings or whatever. And then it starts going up, 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 up. So there are different bounds you can put on your trades. So for example, if you don't want to go through this cycle, you can say you enter your trade in here or whatever, and it goes up, 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 up. And then you can say, okay, when I enter here, my stop is going to be near-term resistance, support in this case. Okay, great. It breaks through this next threshold, and then it starts trending sideways. You're like, okay, if it falls and closes below this next support level, then I exit. So what I did is I moved my stop from there to there. This is how we capture profits and still let things move on the way up. So then you could say, okay, it's running up, and then it starts trending sideways. Even if you choose, again, to overfit, which that in a statistical terms means I know what happens in this sense because I'm looking at a historical chart. So if I wanted to overfit my strategy, I would say something like, oh yeah, I'm going to put move my stop up to here. But that's unrealistic. The probabilistic scenario here would be, this would probably be the last stop that goes in. And then I would run it from here. It would start rounding out. And then I would get stopped somewhere out here. So then I do give up some of my profit, but in the process of attempting to let my profit run, I'm following it. So that's a really, really, really simple way to essentially set a trailing stop for your position But that's not just based on an arbitrary percentage, although there's nothing wrong with those. For me, I like to use support and resistance to essentially determine what I want to use, what makes the most sense for the position. So that's another thing. Here's the most important part. Right here. Just that I get greedy. Here's the problem. When we look at something like this, they think they've identified their problem. And my guess is they haven't. So this is really dangerous. It's really dangerous. The reason why it's so dangerous is because we think we're being enlightened. We think that we're being self-critical, we're really analyzing ourselves, and we're even calling ourselves out for a bad behavior, which is really difficult, right? It feels like we're doing the right thing. It feels like we're being self-critical. Yeah, I'm being greedy. I'm not supposed to be greedy. The problem with this is very, very, very likely that there's way more wrong with their approach than being greedy, but they're not looking because they think they're greedy, and that's the problem that they're looking at. So what I'm highlighting here is that when we're analyzing our performance as traders, we have to analyze the total performance and then quantify our guesses, right? So like if in this example, they give us a ton of different series where they were just letting their profits run and then they turn into losses, whatever it is, that would highlight part of the problem. But is it actually greed, or is it that they're trading stuff that's going up and then down and doesn't actually follow the profit mechanism? So the point that I'm making here is that when I take a look at this kind of thing, I think it's so dangerous because they say it's just that I get greedy. We feel we've identified the problem and we probably fucking haven't. That might be one of the problems. That's probably not the only problem, but we're not looking for other problems because we think we found the problem, which probably isn't the only problem. That's what I see here. So then it says, once you start thinking about money, making plans as if it's a foregone conclusion, you profit tomorrow. Yeah, that's all just terrible, terrible psychology. He started pleading with me to stop trading options, that it's a money pit. He says you could have traveled, married, divorced, lost. Yeah, okay, whatever. Back on stocks. That's fine. Odds are winning are low. That's actually not correct. And when you lose, you have nothing to show for it. Yep, that's fine. Yeah, so here's the deal. When I look at this, I see somebody that is just filled with disillusion. That's what I see. Because options and trading in general is not for most people. That's all there is to it. For the vast majority of people, they won't make money trading. It's not even trading options, it's trading in general. Options simply amplify what you're doing. So for example, if this person had some sort of approach that, let's say they were just trading to the long side, they were trading up, their profit mechanism is up. If they were just trading up and they were really good at picking up, even if they used options or stock, they would still make fucking money. They would still make money. So this isn't options as a problem. This is a trader problem. Now, the reason why their stock portfolio is doing well is because they're enjoying something called positive drift. The vast majority of the stock market goes up in the long run. So even though they'll go through periods where some of their stocks outperform, some of their stocks underperform, and that's what leads to their variance in relation to the broader market, that's why that's working for them. It's not because there's some sort of great stock picker. Because if they were some sort of great stock picker, what you're doing in options would work fantastic. So this is a prime time example of two things I want you to take away. The first thing I want you to take away is that this is dangerous. If you think that there are faults in your trading, we all have them. Do not relegate the performance to one single fault. It is highly unlikely to be the case. It's very likely that there are multiple things that lead into the problem set. The second thing is that options amplify whatever you're doing. So if you're trading, you have to start with the profit mechanism first. You'll hear me say that until I fucking die, because I think all of us as options traders, we start looking at options and trading options before we even have a profit mechanism that works. Start with the profit mechanism, get something that works. Then whether you trade stocks, whether you trade options, whatever the fuck you trade, if you can reliably identify a profit mechanism, the rest are just tools that help you take advantage of it. So that is the point here. Evergreen says, is this guy teaching a course to morons? I'm way too advanced and experienced to listen to this. Been trading options for years. Please say something higher level. So Evergreens, this is a great example of somebody who thinks that they're further along than they are. Because for somebody like you, I would highly recommend, just like in trading, the devil's in the details, I would read the name of the stream. Try that out for yourself. So what you'll notice is at the tail end of the title for the stream, it actually says options trading for, there's a very specific term in there, beginners. That's who this is for. So not morons, that's not it at all. Beginners are people who simply are trying to learn something new. So their starting point and how much information and background they have in something is going to be naturally lower. So that's why we're talking about these things. So yeah, I actually feel a little sad for you, because if you can't read the title of a stream, it'll probably be really difficult to trade long-term successfully. Again, devil's in the details, but certainly wish you the best. So yeah, my guess is this stream is not for you. This is absolutely for beginners, as it's been for the past however many Fridays we've been doing this, like 2-3 months now. So yeah, there you go, fam. Now, back to the next one. Any questions on this one? Anything else anybody else takes away that you think we should cover? Anything like that? Because again, like, there's so much we can learn. Evergreen says, guaranteed on my, oh, I'm not even going to read this. Actually, I'll do everybody a favor, and then let's just, we're going to have to do the children's game, everybody. So Evergreens, I'm going to put you in timeout for 5 minutes, and we're going to see if you can come back and play with the rest of the kids nicely. So there you go. Off you go. 5 minutes. If you can come back and behave normally, we would love to have you. But right now, that's not what's happening. All right. Dr. Zay says, oh, he deleted his comment. No, it's not him. So just to be clear, it doesn't, whenever you put somebody in timeout, it looks like it deletes, I don't know. It doesn't delete all of it, it looks like. I don't know how much of their comments it deletes. Oh, it looks like all of, damn. That's actually kind of harsh. No shit. Huh. I actually didn't know it did that. For you guys, can you see next to their name? Because for me, it says message deleted by Outlier Options Trading, and then it says view deleted message. So I can still click it and view the message. Huh. Learning new shit every day. As I continue to remind everybody on these streams, is I don't belong on any of these things. I don't know what I'm doing. I just like trading. That's pretty much where I'm at in my life. Roaring Titty says, did you put him in timeout or did you ban him or him? No, I try to avoid that. I try to avoid that. So they're just in timeout. I like to give people a couple chances because I feel like a lot of people just aren't used to dealing with people that will set thresholds and then hold the threshold. It's not really that complex, but it's just very militaristic. It's kind of like, if you do X, this is what happens. If you don't do X, then you're good. So I try to give people a chance at that because I think they're used to like the civilian world where like, if you could show up 5 minutes late and it's okay, nobody cares. Like that's not how it works in the military. It's like, there's a fucking time you're supposed to be there before that time, ideally, at least at the very latest on fucking time. And then you're good. So that Lauren says he's gone now and my comment makes no sense. That's awesome. That's even better. I love that. Willie says sometimes people have a bad day too. Yeah, that's exactly it. And that's exactly why I try to give people a chance, right? We've had a couple people pop in the streams, especially the beginner stream for some reason, that try to come off sideways. And I do everything I can to let them hang out because some people are just at a shitty spot in their life, genuinely. And I don't mean that like to cast down on them, but they're trying to find something to do that makes them feel better. So I try to let them hang out as best as I possibly can. I really, really do. But I wouldn't let people be disruptive or disrespectful to other people. There's actually somebody that we blocked because they were trying to talk shit about Roaring Titty, which we're literally not going to have. That's just not going to happen. So, yeah. All right, so that's this. Let's kill this one, move on to the next. And this is a great question. So does theta decay on Friday factor in the weekend already? It's a fantastic question. And I actually think most of you know the answer to this one. So take a look. This is a great question for a beginner trader. They're saying, do they lose $18 on Monday, like theta decay on Friday is higher because it counts Saturday and Sunday, or do I lose $18 for Saturday and Sunday, so $36? So I don't know, honestly, what I'm looking at. I don't see where their theta is on this. It doesn't show me their theta. I'm assuming it's $18 per day? 18 cents a day? That's kind of heavy. Let's double check that really quick. So this is ASTS 23 calls. Let's take a quick look. ASTS. And let's pop over here. They're out in 13 SEP, super short-term expiration. And they have the 23 call. Yeah, damn, boy. Theta is 19 cents. They ain't fucking about. They're exactly right. So you guys tell me, what's the answer to this question? Now, let's keep it a buck. The first answer to this question is, where the fuck is their battery power? The idea of posting a screenshot with literally 2% battery power is crazy to me. So I think we have to start with that and make sure that middle month 2097 is doing okay. Because to be in that kind of mental state, to have 2% battery power at 12:56 p.m. is fucking crazy. We need to get I literally just bought a new watch. It's a dive watch, but my watch came with a power bank. So maybe I don't need the power bank. I think middle month needs the fucking power bank, because this is nuts. 12:56, no battery power. There's no outlet near you. This is crazy. All right. Carlos says, don't they already factor in the weekend? Roaring Titty says, no, they don't factor it in. Ooh, good. So this one needs a poll. Hold on. We need a poll here since there's a bifurcation. All right, let's see. Theta decay impact. Hold on. Does extrinsic value decay theta over the weekend? Yes or no? All right, there's a poll there for your viewing pleasure. I'm actually really curious because the comments obviously show a bit of a split. So far, 100 say yes. There's the no. I see. All right, we'll leave that open for just a couple seconds. That's a great question. I actually really, really like that. All right, we got 17 votes. That's pretty good. So, 18. I'll leave it open for another couple more seconds. Going once. Going twice. Poll is ended. We had 72% say yes, and we had 27% say no. The yays have it. Theta does decay over the weekend. Now, what a lot of people don't know is that theta decay over any time frame is not linear. So to their question of, does theta decay on Friday factor in the weekend already? It's actually a great question. And the answer is partially. So what will happen to them is, as Saturday and Sunday pass, they won't lose $18 per day, because a lot of this is actually factored into the close on Friday. And then there will be an adjustment on Monday. So the thing to know from this specific question that a lot of people don't know is that theta is not linear. It's not one day passes, you lose this exact amount of money. And it's not based on 30 seconds, you lose this portion of that amount of money. It's not linear. So market makers will essentially, Ryan says partially wasn't a pull option. Well, because the pull option is specific, right? Does extrinsic value decay over the weekend? It certainly does. Extrinsic value does decay over the weekend. What I'm highlighting, though, is that it just doesn't decay linearly. So a lot of the theta decay will be factored into the close on Friday with the residual that comes out Monday. It's just not as discrete as theta in and of itself shows us. Theta is showing us stuff in a vacuum, right? So another great example here is, or do I lose $18 for Saturday and Sunday? So obviously here, they're looking at $18. If I look at their option, which we just shared together, their theta's already at $19. So theta moves. Dr. Zay says, so it decays harder on Fridays and decays over the weekend, but not as hard. Yep, that's exactly the way to think about it. And it's not only on Fridays. So the way that this will work is over the, Wednesday, Thursday, Friday, the weekend decay is already being amortized into the options, not just on Friday. It starts earlier, because if they don't do that, people like me will know, like, oh shit, on Friday, they're going to decay out most of the weekend's theta before the weekend. I'm going to trade that. And then I have a great trade because I fade vol on Friday. I gamma hedge throughout the day. So I have no delta exposure, knowing that essentially extrinsic value is coming out. And then at the end of the day, I cover my position. Don't make a ton of money on any one of those, but you can scale that easily. So that's why they start earlier, because then I'm forced to expose myself to way more market factors as a trader. So it's not as linear as that. Roaring Titty says they're going to lose more than $18. They may or may not. We can't tell yet. So again, the fact is that it just won't be a linear $18 per day as they're guessing. And again, this is a great question. So the takeaway from this one is that leading into a weekend, typically starting as early as Tuesday, but typically Wednesday, Thursday, Friday, market makers are going to start valuing the options and taking out an additional portion of theta to account for the weekend, because a lot of these products don't trade over the weekend. So it accounts for that dead time. Now, the trick here is that it still can move over the weekend. That's why it's not fully removed for the weekend, because some news can come out about this individual stock that moves it on the weekend, and then as soon as the market opens on Monday, it flies. So this is a really great question. It's a bit of a technical question, which is why I think it's important for traders to know theta is not linear. Not only is it not linear in its overall decay profile, but the way that it's applied over the weekends in a smaller profile is important. So I'll show you this. So this shows you theta decay over different time frames, right? So you can see as you get close, this is, oh shit, I moved it. This is using at the money options. I also realized that I have my old logo in all of these. That's super frustrating. Don't love that for me. And I also realized that this isn't lined up with the other one. That's also annoying. Okay, that's better. All right, so now this is better. Anyways, you can see theta decay in and of itself, day over day, is not linear. And then week over week, specifically using the weekends, it's not linear. Now, an even more important point here is for my options traders, specifically my vol traders. I'll show you a study, because the weekend carry trade in SPX is something that I almost always have on to some degree, and you can hedge it with futures, which is fantastic. So let me see if I can find this study for you really quick. Again, because you should not take Eric's word for it. You should be able, this one would work, overnight drifts. I want to see if I can find this specific weekend effect. Let me see. Sorry, I want to find this for you, so just give me a second. I try to provide as many source documents as I possibly can, because nobody does that and it's super annoying. But we're looking for something called the weekend effect. Monday effect, that's not it. This is just looking at anomalies and then non-trading hours. I guess we can look at both of these really fast. And I'll throw links to both of these in the chat for this one and then this one. And we're going to look at both of them together. Okay. let's see. Dr. Zaya says, wait, how does news affect theta? News doesn't affect theta. News can affect extrinsic value technically. But again, remember, the way that we use theta is perverse. We use it colloquially different than what it actually is. And again, when we're doing like these beginner sessions, I like to be very, very clear about these concepts just so that you understand. And then if we want to get lazy and use theta to represent time, that's okay, right? That's what most of us mean. But theta actually is time decay. That's what theta, it's a measure of time decay. Theta as a term is not time. We just use it for time colloquially. But theta in a technical sense is a measure of time decay. So the reason why news and stuff like that can indirectly impact theta is because it can impact the extrinsic value of an option by moving the underlying. But to the point of the question, theta in and of itself is not directly impacted by news. It's simply impacted as a result of the underlying moving and then intrinsic and extrinsic values sliding accordingly, yielding a different theta based on that. Let me know if that answers the question. Lauren says, I find that delta and theta really confusing, makes me want to eat paste. I have a video for you then. Hopefully, Greeks. I have a video that dives literally into all of the Greeks. It's like not super long. It's like 16 minutes. So this is for that Lauren, that video I just dropped. And that video is literally all about the Greeks. I go through first order Greeks, second order Greeks, third order Greeks, spend most of the time for first order Greeks because that's what impacts most people. And for those that don't know, the first order Greeks actually includes a second order Greek. We just often refer to it as a first order Greek. That's just kind of like a nerd fact that I don't really get a chance. Like if I tell my wife something like that, she couldn't possibly care less. So I'd share it with you guys. So fun fact. I'm essentially an encyclopedia of completely and utterly useless information. It's not necessarily something I'm super proud of, but it is what it is. All right, so we're through our first spin drift. We're moving over to our reserve watermelon seltzer water. And we are ready to move on here. So here we go. So this is looking at non-trading periods, right? That's what this study looks at. And it says, we document the striking results that U.S. equity premium over the last decade is solely due to overnight returns. The returns during the night are strongly positive, and returns during the day are close to zero and sometimes negative. This day and night effect holds for individual stocks, equity indices, and futures contracts on equity indices. Night returns are consistently higher than day turns across the week, month, and times of year. So this essentially is highlighting a really important function of markets that a lot of people don't know exists, which actually really surprises me, to be honest, because it's nothing that's like revolutionary or complex, at least in my opinion, but you'll see this essentially everywhere. So I ran a study actually for the pro members, the Patreon members for the outlier community, and I was essentially walking them through movements in SPX and how it breaks out throughout the day. So what I do is I like to look at products like this that I trade variance risk premiums in, and I'll look at how it moves for each 15-minute interval throughout the entire day so that I can see where the bulk of movement occurs. And in something like SPX, you'll notice if we look over any sort of significant time frame, a lot of the movements that you'll find happen within the first and last 15 minutes. Of course, this isn't always, right? So this is a big move that's like an hour into the market, right? So it's not always 15 minutes, but very frequently, the first 15 minutes and last 15 minutes of the market will be very busy. That's where we see overnight orders flooding in that we're resting. And then that's where we see everybody positioning for the next day. So you'll see a lot of active style traders like myself will favor the last hour of the day heavily and the beginning part of the day, to be clear, for like opening range breakouts and stuff like that. But the big movement from overnight tends to come from pension funds and like these really big institutions that are just resting orders overnight to get hit on the next open. So you'll find this trend holds over time with the vast majority of products. So that's essentially part of what this is identifying for you. Let me see. Zachariah says, is it distracting to ask about holidays? Same, right? No, it's not distracting at all. Dude, this is a completely open conversation. We talk about straight up whatever you guys want to dive into. Zachariah says, holidays, same, right? Yeah, exactly. So if we have an extended duration, technically speaking, there's even greater opportunity to capture variance risk premiums from there, because the market has to account for that additional time off. And again, non-trading periods tend to be really efficacious for stuff like that. The risk you run is if there's really terrible news that comes out, a war breaks out or whatever, and you get this massive gap on the open. But again, like for the way that I trade, I'll use SPX, and then I can always hedge with the futures if something really terrible happens, effectively creating a spread. So Zachariah, it's a fantastic question. Nothing wrong with that question at all. And it's completely the same. It changes the way that they essentially have to amortize theta. Great question. All right, let's take a look at this one. The evidence shows that the size and effect, the weekend effect, dividend, da 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 da. So let's open this one really quick. And then let's search for, and actually give me 1 second, because I have to have this paper downloaded, and the fact that I couldn't find it makes me very angry. So I have to see if I can find this really fast. What's the name of this? Anomalies. Aha. See? I have every study. Okay, that's a lie. It's kind of dramatic. But I have most studies downloaded and in my my Kindle. Again, for those that are in the Discord, you'll see me post both in like the Patreon side and like the reading list. We have like a reading club where we just share the shit that we're reading. But then I'll also drop stuff like this in the beginner section of the Discord. Like, as embarrassing as it is, this is what I read, man. Like, this is the stuff that I don't know why. I don't know what the fuck is wrong with me, but I love this shit. So anyways, this one's a little bit old. I think this one's from like early 2000, but I think it still holds. Let's take a look for the weekend. It's the weekend. Yeah, 2002. The fact that I know that is also not great. Okay. So French 1980 observed another calendar anomaly. He noted that the average return to the S&P composite portfolio is reliably negative over the weekends in the period of 53 to 77. The dependent variable is daily return to a broad portfolio of stocks, Schwert portfolio based on Dow Jones. So they're talking about essentially the drift over the weekends. And you can see the way that they estimate it. I don't know if they talk about volatility in here. They might not. I don't think they talk about volatility in here. My bad. That Lauren says, I'm glad someone reads it for when we have questions. Yeah, and I get it. Like, that's why I try to summarize a lot of these studies for you. I'll always provide the studies like this and give you a link to them and stuff. But I also understand not everybody was dropped on their head as a child and wants to read this shit. I do. And I do read it, but. Vladimir says many individual stocks react to news and SEC filings, and almost all of this is disclosed in extended hours when options trading is not possible. Yep, that's correct. That's absolutely correct. That's why that there's still extrinsic value assigned to non-market or to non-trading periods. My wife is texting me asking about dinner, so we got to see what we're going to order. I'm thinking, what do you guys think? Barbecue? I think barbecue, man. Barbecue sounds good. All right, so that's these. I think we can kill these. You have those. Let's take a look at this one. So we killed this. Here we go. Option volatility and pricing for the average Joe. I love options. I really want to learn options, and I've already got a few books on trading and essentials like options as a strategic investment. Shout out to you. Acceptable answer. That's an acceptable answer. But options volatility and pricing, this one scares me. As a simple man, follower of 3, longshoreman, background as a carpenter, am I entering a world of pain? No, you're not. I had my strong maths in school, but that was 20 years ago. Should I take on math lessons to be able to wield and master options? So this I think, Dr. Zaya says you get barbecue every time. That's not true. I just get barbecue a lot. But not every time. Don't do me like that. Do Mexican a lot too lately. Dust to Dust. What up? Good to see you. So what do we think here? You guys tell me. Have you guys read Option Volatility and Pricing? And do you think it's required? Like, do you think that the book has materially changed the way that you view markets? And you give your answer and then I'll give mine. But I think I have two versions. Yeah, I have paper version down here. Reese says, I have not read it, so I hope not. So here's said book. It is about 500 pages long. Yeah, about 500. And here's what I would say. I think, well, actually, I can tell you exactly what I would say because I offer this to everybody. For everybody that doesn't know, if you go to my website, if you go under resources, I literally have essentially a straight up guide for new options traders. It's just a Google sheet that loads in here, but it's also, you can click into any of these. Actually, that's another quick question for you. As you look at this top box, would you think to click this or do you need this one here? Out of curiosity, from a user's perspective. Vladimir says, Chinese food is always great and keeps your body MSG levels. I actually don't disagree. Or Indian, maybe. I'm kind of down for whatever. All right, Dust to Dust says top link. That Lawrence says bottom. Yeah, okay. So my instincts are correct to have both. Because I just expected people to naturally gravitate to either the titles in clicking or these, which is why I include both, right? You can't, I think they're both right. So anyways, on this, if you go down to the bottom, you can take a look at Options 101. This is what I consider to be the basics for options understanding. Options as a strategic investment, option, volatility, and pricing, advanced trading strategies and techniques. That's what this book is. This is literally the second book I would recommend to any options trader. So in my opinion, this is required text. That's what I say. Now, for this person, this is the problem with trading, is people want an easy, simple solution. It's just not what you're going to find in markets. It's just not what you're going to find. It looks like Mel is down for barbecue or Indian. So you guys have to pick for us. Do we do barbecue or Indian? She's down for either. I'm down for either. Joe Tato says, I failed reading comprehension like every time it was tested through school. That's cool, man. That's back in school. That's old you. You're now new you. Everybody says Indian. All right, Indian it is. I'm down for some Indian. Oh, damn. Willie, throwing the... I tell you what, Mexican sounds good too. Damn it, Willie. You're kind of doing me dirty here. Let's see. Damn it. Ooh, I actually think I'm going to do Italian. I'm going to throw a complete curveball at Mel. She's going to be like, what the fuck are you sending me? But I had Italian ready to go before. So it looks like that's what I need in my life. Got to follow the body. So, in my opinion, I think this is required reading. The reason why I think it's required reading is because it goes deep into detail on how markets behave, how market makers behave. Damn it, she doesn't want Italian. So it looks like we got to do Indian. I had a feeling going for that curveball was not gonna float well. Maybe I'll see if she's cool with Mexican. This is actually hilarious. All right, we're doing Indian. She doesn't want Mexican either. I feel like Indian is a good choice. I have no regrets with some solid Indian. Dustin Dust says, Eric, that's the second book you 100% recommend. What's the first? Options is a strategic investment. That, I think, is probably the easiest book for most people to pick up and start learning about options. It's not quite as technical as what you will find from option pricing and volatility, but it is a little, I don't want to say it's a little heavy. Like, there's parts in it that can be tricky, but in general, I think it's pretty reasonable. Damn. So now I don't know if I want chicken biryani, or if I want like butter chicken. Shit. Dr. Zayas, don't you dare hit me with that joke. I love that joke. That's probably one of my favorite jokes on earth. I won't steal it from you though, because somebody else might ask you what, and it's very fun to be able to answer that. So I won't steal it from you. I don't have that in my heart. Such a good joke, especially if you can get somebody new with it. God, that's great. All right, so I'm doing butter chicken and garlic naan. That will be the movement. All right. Back over to this. Damn, she's quick out here. Vladimir Off Putin says, as a new options trader, I have a separate account funded by a lucky trade I have named Entertainment. I just don't have confidence or knowledge to risk my money just yet. I think that's okay. I think Vladimir Off Putin, for you in that, I would think about paper trading. Like, literally, I have a video coming out in not too long. I think not this week, but next week. This is a video that's coming out tomorrow. I actually have to download this. But yeah, I have a video that's coming out that explicitly is going to be about this exact thing and paper trading, because I genuinely believe paper trading is such an incredible tool for that exact thing that you're talking about, Vladimir Off Putin. But I think that you have to think about what you're trying to accomplish and then essentially treat your trading account like that. That's what I think. Roaring Titty says, what's the answer to the joke? It's above. Roaring Titty. It's a fantastic, that's like literally one of the best jokes I think somebody could have. Yeah, I literally, my poor wife probably has heard that joke more times than anybody really deserves to hear it, but it's just so good. It's just so good that I don't know. It's fantastic. So for those that didn't get a chance to enjoy it, make sure you read the punchline. So back to this. Yes, I think it's required. No, options trading is not easy. No, it's absolutely not for everybody. That's just kind of how it goes. So when I think about what I think works best with learning to trade options, it's a mix of fundamental understanding of theoretical concepts, and then it's starting as fast as you can on the more complex components. So things like how to take the theoretical components and then use them live. That's really not easy. And I think a lot of people struggle pretty hard with that exact process. But to me, that's kind of really where that entire process comes together, because you can be super theoretically sound, like completely theoretically sound. And then you can not understand at all how to actually trade. So to me, you kind of have to have a really strict balance of both. That's my overall thought. Vladimir Off Putin says, I've tried paper money, but feel that I'm reckless there. To me, that highlights a massive discipline issue that is it's showing you up front a problem that is there. There's a massive problem with that. If you are that kind of person, and you're not alone, lots and lots of people are like that. But if you are that kind of person that's like, man, I just can't take this seriously because of, X, Y, or Z reason, that is absolutely going to come out to bite you in the end, no matter what. Like that problem is going to show up in another way if you don't take care of that problem. So paper trading, again, is giving you a fantastic preemptive heads up that you have a problem of some sort. And again, I'm not saying that you have to, fully treat paper trading as if this is, your livelihood and stuff like that. But if you can't take paper trading seriously, then the probability of you like being able to take trading as seriously as you likely need to is actually pretty low, in my opinion. So that's at least the way I look at it personally. And I hope it's not the case, right? Like I'm not saying that to like wish it on anybody, but I think that is my general instinct towards that kind of thing in the beginning, because you'll find people will say that all the time. And I literally can tell for those kinds of people, the problems that they're going to have based on that kind of behavior. Zacharias says, well, recognizing the problem is better than most. I agree. I completely agree. So let's talk about that. Let's talk about that exact thing. Again, I have a video that's coming out next weekend on paper trading. So you guys talk to me. What are some of the ways then, if at least I think paper trading is important, it doesn't mean that it, is super important. But if I think it's important, what are some of the reasons why you might think that I think it's important, specifically in terms of how can you adopt it if you identify with yourself as, I have a discipline problem. I'm not doing a good job treating this as real money. How can we fix that? Any ideas? That Lauren says, I started with paper trades and small stocks, so it didn't hurt so badly. I did well with SoFi. Yeah, that's really solid, right? That's starting small. I think that's fantastic. That's a really, really great approach, I think. All right. It looks like no ideas are necessarily jumping out, so we can hit this together. Roaring Titty says, I reduced the size of the cash. That's okay. Change the money to percentages. That's kind of for sizing, which those are good ideas for sizing. So here's what I would tell you. If you're the kind of person that's coming into paper, like I give this example all the time. I'll tell you right now. I'll look at my log right now. I have to go to my data tab. Okay. How many paper trades do you think I have on right now? I am a full-time trader. I've been trading for almost 17 years now. How many paper trades do I have on right now? Vladimir says, I've made hundreds of thousands on individual stock trades, but the clock ticking with options is a big difference. It is, but it's not. Again, like if you're making that kind of money with trades, then you probably have a profit mechanism that works. And again, like we were talking about before, if you have a profit mechanism that works, options are just going to amplify it. They're not going to hurt it. They'll hurt it if you don't know how to use options. But they're not inherently going to hurt it. Okay, so Elong Song says 10. Dr. Zaya says more than 10. That's a great guess. Willie says 20. Reese says 100. I'm taking the over. And Reese would be the winner. Right now, I have 1,087. 1,087 paper trades on. I have them split into 3 different segments. There's what I call a portfolio mirroring segment that looks at my portfolio as it is with slightly different permutations. So rather than right now essentially shorting things like energy, I'll short something else that I also think is weak, and I'll run them simultaneously and compare notes. Roaring Titty says, like, currently or over the life of your trading career? Literally right now. Like, that's what's on this second. So Reese says, do I get an internet trophy? Yeah, I actually think that that's fair. I will award Reese. Gets +1 fake internet point. I got to find my little trophy. There it is. Good call, Reese. Reese gets +1 fake internet point. So I have that first segment that's mirroring slight variations to my portfolio. I have a second segment that looks at a completely different portfolio structure. So I'm essentially testing an alternate portfolio that has a completely different disposition to what I have. I use things like the core allocation and the speculative trades in that portfolio to essentially show me other elements that might be contrary to what I think. So for example, right now, I'm still long deltas and I have a lot of short deltas overlaid. However, when I look at the portfolio itself, net, there's still some long deltas. So in my second kind of segment, I'm looking at an alternate portfolio that's primarily short deltas right now and has a little bit of long deltas, kind of the inverse of what I'm doing. And then the third one is variations of literally all of the strategies that I run regularly. That's it. So by doing this, I'm able to test live information because, as you all know, I like to look at data. I'll back test, I'll forward test. But even in the process of back testing, I know and can recognize that even subconsciously, there is back-end processing that's happening that's tainting the results of what I'm doing that I don't want to happen. So one of the ways that I combat that is by having all of these different paper trades on at a given point in time to allow me to collect raw data based on what I don't know is going to happen. I have no idea what's going to happen over the next week. So that's why I do it. So the way that I would encourage a newer trader to take paper trading seriously is I would do something like this. I would show them this. And then I would say, let's say you're starting at $5,000. Let's say that you're able to save on average $1,500. Let's say you're going to look over 20 years. And let's say that we're starting with a 10% return. Well, what would I get if I have an 11% return? Well, in that same time frame, at an 11% return over this 20-year time frame, I go from 1.06 million to 1.2 million. So it's $200,000. That doesn't sound like super life-changing or crazy. Okay. But then let's fast forward this out to 30 years. Now what does this turn into? 1% variance between this 10% and this 11%. 1% variance takes me from 3 million to 3.7 million. $700,000 over the same time frame for 1% difference. I care about that 1%. I care about that 1%. So this isn't like some magical big return. This is literally the difference between 10 and 11%. But that 1% over a long enough time frame is massively impactful. Now, this becomes even more important. Let's say that you have a really good return. Let's say that you return on average 22%. Let's take a look at what 22 versus 23% is. You go from 33.7 million, 33.8 million to $41 million. That's from 22% to 23%. I care about the 1%. In this example, over a 30-year time frame, it's almost $10 million. I care about that. I absolutely care about that. So for me, paper trading is a way to accomplish two things. There are two primary purposes of paper trading. The first one is for new traders to avoid this. If you're a new trader and let's say that you have a 40% drawdown on your account, After that 40% drawdown, you now require a 66.7% recovery in order to get back to break even. You need a massive, massive recovery in order to get back to break even. So when you're a new trader, in my opinion, the game is not trying to turn a small account into a big account. As annoying as that sounds, it's simply so unlikely to be the case that we're going to take a really small amount of money and turn it into a massive sum of money. Not impossible, but it's insanely improbable. So in the beginning, the point of trading is to not lose a bunch of money and then start having to run uphill. That's the point. It's to learn the skill set without burning a shit ton of money learning it. Paper trading helps you with that exact thing. So for the beginner paper traders, I would literally frame it as I am building the exact skill set that I'm going to use and rely on for myself to hit my financial goals. That's the point of paper trading. So if you look at paper trading, you can't take it seriously. You literally can't take your fucking future seriously. You don't care that much. That's all there is to it. Now, I'm not saying everybody has to paper trade ad nauseum. I'm just saying that if you find yourself in the bucket that you just can't take it seriously at all, that tells me that there's a psychology problem factored into this thing. So that's what I would tell to the new paper trader. Now, for the non-new paper trader, experienced traders like myself, I use it for data. I use it for data collection. So for me, the new paper trader, the entire goal for a brand new paper trader is essentially to trade that paper trading account as close as humanly possible to how you think you're going to trade your real money. That's the goal. And then for experienced traders, your goal is to see how can you learn and enhance your strategies to get that 1% that I just showed you is so important. That's the goal for experienced traders. So that's what I think. If you are a paper trader and you're struggling to take it seriously, I would just take a little time, zoom out, and think about what you're trying to accomplish and what paper trading allows you to do. Because I genuinely believe if you get to the point where you can take that more seriously, I mean, damn, it's so powerful of a tool that just for whatever reason, so many people have a hard time latching onto. And I sort of get it. It's boring if you don't think about it in that context. But it's like the same thing I tell people, about like military training. If the only way that I was able to train in the military is by, essentially going only to combat, and that's the only time I can learn, there's gonna be a lot of dead motherfuckers if that's the only way I can learn. So that's my thought. A little bit of a long soliloquy about things, but the reason why I think it's important to like really dive into that is because I think taking it seriously literally can be life-changing. And I think a lot of people sell themselves short not doing so. That's what I genuinely think. So that's that. Now, there's a couple other things that I said I wanted to look at with us. So I vote we now pivot onto some of those. Any questions though about the paper trading thing? I'm hopeful that that even like generally makes sense to us. Because that's why, again, like that's why I bring it up, is because I think that it's at least a usable data point in two different ways. Whether you're a new trader trying not to lose money but learn the skill set, or if you're an experienced trader that's trying to make a lot of money. Dust to Dust says, make it more interesting. Put 10% of your paper trading profits into your cash account. I love that. I think that's a good idea. Vladimir Putin says, are you more aggressive when playing COD than in real life? Same to me when paper trading. Yeah, but again, you can't compare those. Because if I'm training in real life for what I do in real life, I take that deadly serious. If I'm playing a video game where its very purpose is for entertainment, that's the only reason why we play Call of Duty or any of these other games, is for entertainment. Of course, I don't take it that seriously. I know I'm going to respawn, but that's not what this is. I'm not talking about, I don't get to respawn my capital. If I have a 40% drawdown, I need 66.7% positive return to get back to break even. There's no respawn. I don't get to just come back. So when I look at something like this, I actually wouldn't equate it at all to a video game that's entirely predicated on leisure. I would actually equate it far more to real life training for whatever it is that you're going to be doing, whether it's going to combat or, you know, whatever it is. Just a more real life practical application, I think, is the broader point. That's my opinion. Zacharias says, train hard, play easy. Yeah, well, and that's actually another funny thing that I'll remind traders of all the time, is that the actual process of trading is about as easy as it gets for me. And that's not hyperbole. It's really not. Trading in and of itself is easy for me. And the reason why it's easy is because everything else that I do to lead up to whatever it is that I'm, you know, trying to build the skill set of. So in this case, trading, I do all of the work ahead of time, all of the work ahead of time. So then in this case, it's just another day of doing what I know I need to do inherently. So all of the work for me in trading is done ahead of time, and trading in and of itself does not need to be a difficult process, in my opinion. But all of the work to make it not a difficult process has to be done before you start trading. Paper trading helps a lot with that. Reese says, is S&P inclusion a tradable event? Yeah, definitely. Sorry, I didn't realize that you had asked that before. That's my bad. But yeah, Reese, so things moving within the S&P 500 is absolutely a tradable event. They tend to exhibit drift over a set follow-on period. And you can actually look at there's a study on it. Let me see if I can find it really quick. That's from a market inefficiency book. But I wonder if SSRN has something on it. And then I need to press send on this order. All right, dinner order's out the door. And then let me see if I can find this. Maybe easier just to search it. Studies on stocks being added to 100. So this isn't the study I was looking for. But this is, let me see. I think this is the one I was thinking of. Yeah, this is the one. So there's two studies that I believe you can reference. The first study here is talking about, again, like the actual reference effect. And then this study essentially is just summarizing it. Let me know if that makes sense. So this one, if we take a look together, you'll see a few things I think that kind of point out to me. The main thing is that things being added to the S&P 500 typically see some sort of movement post being added. So you can see increases in the share values, but you'll see that the data itself is slightly mixed. And that's why I think this study is a good one to read. So we can go down, we can just read the conclusion together really quick. The S&P 500 index has no permanent effect, right? And I want to emphasize that specific line, permanent effect, because guess what? As traders, we don't care about permanence. That's not what we're trying to trade. I'm not trying to trade the permanent effect of something. I'm simply trying to trade the effect. So the fact that it's not permanent, I don't care literally at all about. What I care about is it something that's tradable, which it absolutely is in the short term. So I think as long as you have a logical approach in terms of when you put the positions on and for what duration, I think it makes a ton of sense. Vladimir Putin says, again, added to S&P 500 after hours when options were not traded. That doesn't matter. It's not an overnight effect. It's not something that's going to come and go today. It's more of a momentum effect. It takes time for it to be priced in. So yeah, it doesn't matter that options weren't trading tonight or on Palantir. It'll be completely fine. It's something that you can trade over a duration. So yeah, don't sweat that. All right, so let's close that out, close that out, close that out. That was a good one. Let's see if there's anything else that we want to grab from this real quick. Scoot this over. And let's see. Dr. Zay, so a straddle would make sense. That kind of is more for, well, it depends. For me, I would probably play more so the positive drift myself. But if for whatever reason you felt that there was a higher probability of, just movement in either direction and you couldn't, you don't have an assessment on which direction, then yeah, I think it's fine to use a straddle, but that's kind of the purpose of it. But for me, that's not the way I look at it personally. All right, this one looks like a good one for us. We'll read through that one. Let's talk about this one because I think there's some problems here. And then let's look at this person's blind spots. All right, so this one talks about earnings crush. It says, I've seen a lot of references to IV crush during earnings that lower an options contract value. But what really happens during earnings that leads to IV crush? All right, so you guys talk to me. What do you guys think about this? What really happens during earnings that leads to the IV crush? What happens? Binary event concludes. Yeah, you got to be more specific than that, though. No plus fake one internet point for that. I consider that a partial answer. The news is out there. Hype is over. That's better. Roaring Titty is moving us in the correct direction. So Reese gave a more holistic answer, but I think Roaring Titty beat him to it. So Roaring Titty, there you go, with plus fake one internet point. Willie says IV crush is elevated extrinsic value off the surge in demand in options near earnings. And once past earnings, you get crushed. That's not exactly correct, actually. This is good. I'm glad we're talking about this. G36 says the market is pricing a larger move from the earnings. Afterwards, the expectation is gone. Yeah. So G36 is also correct. So G36, you also get plus fake one internet point because I think your response expounded a little bit on the effect. So here's what's going on. Before earnings, let's find something that has earnings. Let's do APLD. Somebody threw that in the chat before, so we'll take a look at that. So APLD had earnings. Leading into earnings, we don't know what's going on. We do know that there's going to be new information critical to the valuation of a stock. We know that that is going to come out with certainty. That's going to be here. So that leads to a heightened expectation of implied movement. We know information's coming out that can move the stock. That then means we expect movement of some sort. So leading into earnings, the expectation for implied movement is relatively high because we're getting information that can move the stock. Once that information is released, it is then priced into the stock. That's why if you go through something like this, you'll see the orange line is implied volatility. Notice how the orange line is downward sloping. Typically through earnings, not always, but typically through earnings will be downward sloping. So that simply means that the implied move based on the information is factored in, and now we're not expecting as much movement. Now, the second question that they had that was a great follow-up question is it a guarantee for stock options to have a crush on earnings? What do you guys think about that? Is it a guarantee? It's another fantastic question. You tell me. Dr. Zayas says crush happens when the unknown becomes known. That's good. Willie says depends on the news. Willie is correct. So Willie... G36 says IV will still decrease, but if the move is larger, then the delta can make up for it. That's incorrect, G36. Elong Song says no guarantees, so Elong Songs also gets one. Reese says yes, that vol will decrease, but delta can easily overwhelm that. Not necessarily. Tommy also got it right. Dr. Zayas also got it right. So 2, 3, 4 trophies, plus fake 1 internet point to those 4. Now, this is one of those things that, again, the devil is in the details. Is it guaranteed? No. Is it probable? Yes. The vast majority of instances, you will see implied volatility contract through earnings. In this instance, after earnings, it went up. This is the day before earnings. This is the day following the release. So in this case, it went up. It's seldom the case, but the reason it can go up is if there's a terrible or a big piece of information that just wasn't expected, and it causes even more expectation of movement. That's exactly why you'll see it go up again sometimes. The overwhelming trend, however, is that it typically will go down. Overwhelming trend, but not always. And to this person's question, certainly not guaranteed. When does it happen? Another great technical question. So when we get this earnings crush temporally, when does it happen? Busy Blend says, 90% of the time IV does pump when earnings is near. That's also correct. I wouldn't say 90% of the time because I don't know if that's accurate and I don't like giving bad data points like that. But I can tell you over 50% of the time, aka the majority, IV will expand starting 2 weeks out leading into earnings. So nothing wrong with that. But you guys tell me, when does it happen? So we know that IV tends to decline, okay, but when does it typically happen? Anybody have any ideas? After the release, that's a fair point. Need a little more specific than that. Tommy says when earnings come out after the call, that's moving in the correct direction. Reese is the closest so far. G36 is wrong. I would say Tommy and Reese are the most close. So Tommy and Reese, you guys get plus fake 1 internet point. Gotta get my little trophy out. There we go. Busy took the under the null hypothesis and says before earnings, which is incorrect as well. Zachariah says right before the call, from what I see, that's also not the case. Tommy says, can I convert my points to Bitcoin? Potentially. Yeah, you'll have to see how you redeem them. But yeah, I think you're more than welcome to convert to any of your preferred denominations. So the period in time in which it actually moves is not going to be immediate. The period in time for the IV crush, I don't like calling it IV crush, to be honest, just because it's kind of like a beaten down phrase. I don't really like it. So it's just, I don't know, like, I guess a slight pet peeve. But let's see if we can find something that recently had earnings. Let's do, I think one of these. Yeah. This is earnings within 5 days. Oh, I forgot. We never finished fixing this fucking scan. Damn it. Let me see if this does it. So this should be looking for stuff with earnings in the past couple days. Yeah, okay. So that at least worked. Let's take a look here. IoT. Let's take a look. Let's variance interest premiums moving. Oh yeah, because this is too short of a time frame. Bad. Don't think it will change much here. It will be really hard to see though. When did it? Oh, I need to go back a little bit further, my bad. I want to give us a little more time to differentiate. Let's go back. Roaring Titty says Ivy goes down when volume goes away. Sort of. That's not incorrect, but that's not necessarily what this is tied to. So let's go back 5 days. I want to go back a little bit further. And yeah, this would be okay. So Ulta had earnings on Thursday. So if we take a look at implied volatility, this is using 4-hour candles. So in this case, they reported after the market here. So we can see short-term vol started immediately after they reported, and it continued through the first half of the next trading day. And then it leveled off here into the tail end of the next trading day. So in this case, it's showing you that generally speaking, you will find that earnings volatility in a vacuum, isolating the volatility for the release itself, will tend to come out within a few hours after the open following earnings. And then there might be some sort of persistent drift that occurs. But the movement that I personally would attribute to the earnings release in and of itself would be probably a few hours after the open. So that's another great question from them. All right, we got a few more minutes, so let's move on to another one. I don't like this one. I'm new to options, haven't done any yet, trying to understand them, have come up with an idea, and I wonder if it's any good. Like, is it a normal idea? My idea is to sell covered calls on KO stock that I have. If I do this, my only risk is that the price goes above the strike price and the calls get called away, and I have to sell my stocks for less than they're worth at the time, and I get to keep any premium paid for the beginning. So, yeah. There are flaws in this methodology. So one of the first flaws that I would highlight is specifically the risk component. My only risk is that price goes above the strike price. Is that correct? Is that the only risk that they have? I would argue nay. Roaring Titty says no. Exactly. You guys are directly on it. Give me 1 second. I'm going to go grab a reload seltzer water, and then I'm going to be right back. But you guys are on it so far. Oh, there's the... Wait, that's kind of cool. Look at me go. Interesting. Hi, guys. From over here. I kind of like this. All right, I'll be right back. All right. We're back at it. What do you guys think? I kind of like that cutout one was pretty cool. Maybe I make myself even a little bit bigger. Look at that. What do you guys think? Better that way or no? All right, let's see what you guys say. The calls are at risk as well. I wouldn't say that personally. Reese says, which ticker was it? If dividend, that's a factor. I can't believe you guys are missing this. This is fucking nuts. Loss upside. Yeah, there you go. G36. G36. G36 got it. Nice job, G36. So G36 hit the nail on the head. Let's structure. Let's pick something. They have Coca-Cola stock. KO. And let's say that they bought in at like 68. And let's put on a prospective trade here. So we'll go into buy. Let's say that they have their 100 shares. And then let's say that they have their 100 shares at 68 bucks. And then let's say that they sell their short call, 42 DTE, whatever. They're getting their few dollars here. Analyze. Where's the risk in this trade? The risk is to the fucking downside. Now, they're not viewing it as a risk because in their mind, they're like, oh, it's Coca-Cola stock that I already hold. So they're completely not understanding that the risk here is the downside. Like that's exactly what the risk is here. So the problem with this is that, again, like what most traders do and tend to do, they're simply focusing on the profit. How much money do I stand to make? That's what they care about. I had a MRI earlier today for the whole back bullshit that I have going on. And I had the contrast injected, which apparently has like fucking metal in it. So your boy's trying to flush the metal out of the old system. All right, back to you guys. So yeah, G36 definitely gets a point here. At G36. There you go. Reese says, I said that only giving it away all upside potential. Yeah. So the main thing here is the downside risk. That's just to be abundantly clear. That's precisely what they missed in this. That's actually like really, really dangerous to them, if we're being honest, because it shows like an entirely skewed perception of risk. So now for everybody else, how can we fix their perceived risk? There's an easy way to fix this problem. How do we do that? Ratio diagonal. That's a massively effective way to do it. There's another way that's more similar to what they have. I would use a ratio diagonal simply because I would benefit from, I would prefer the leverage than holding the shares. Easy. That's a easy answer for me essentially every day of the week. Hold that over the shares and you gain way more leverage. I absolutely would take that. But that's not actually what I'm thinking in this case. Reese says I can see if they already hold that stock and have downside risk already. Yeah, it's whether they hold the stock where they're putting on the stock for the ratio or for the covered call, it doesn't matter. If you hold stock, there's downside risk. People forget that literally all the time for some reason, but that's the risk of holding the stock. Now, the funny part about covered calls is that Reese says in their mind, they may already have it. So the downside risk is already prevalent. Right. It doesn't matter, right? Like whether in their mind it's there and exists or not, it doesn't, the point I'm highlighting is that it's there, regardless of how they're trying to rationalize the downside risk or lack thereof. It's there. That's the primary risk in this trade. And the important point, Blizzy says, but the downside risk doesn't matter. It entirely matters. That is complete folly. Whether or not a trader is willing to hold a stock doesn't negate the downside risk. It's still there. And it still has an impact of the portfolio. Again, that's the naivete of traders that don't like realizing losing positions or having losing positions tie up capital for extended durations before they can get out at a profit. That's the exact problem with this kind of thing, is that traders think that exact kind of way. They think, oh, well, I hold the stock, I'm okay holding it. And even if they're okay holding it, guess what? If Coca-Cola drops, let's take a look at an example. We got in at 68. Let's pretend Coca-Cola, instead of being right now at 71, let's just not even, I'm not even going to pick a crazy thing. I'm going to pick something that's happened recently. Let's go over the past year. It was down at $51. So let's say instead of at 71, it's at 51. I'm holding a position right now that's a $1,600 loss on a $6,800 outlay. I forgot, I have a calculator over here and I don't have to do it there. So we got in at, we were calling it 68 and right now it's running at 51. So that's actually funny. It's very satisfying. It's a 25% decrease in value. So now you're holding something that's down $25 and now you're like, shit, well, I don't want to get out now. I still like the stock long-term, and that's okay. You can like the stock long-term, but guess what? While this $6,800 is tied up in this losing stock position, it could be and should be making money, but it's not. It's tied up in this, and this position gave you $86. That's what you got on your short call. You made $86. And now the underlying is trading so low that you can no longer sell calls against it, above your basis at least. So then you're like, okay, well, maybe I'll sell calls below my basis. Well, now there's a risk. The risk is if it starts skyrocketing up, now you have to try to manage this short call, again, tying up capital longer and longer and longer to extend your profit trivially. So this is a massive, massive risk that, again, traders talk themselves out of. And again, there's nothing wrong with accepting this risk. There's nothing wrong with saying, that's my approach. I don't care about the opportunity cost. I'm okay. And you can do that. That's completely okay. But it's just important to acknowledge the cost associated with it. There's a difference between saying, I am okay and acknowledge the risk and opportunity cost. There's a difference between that and saying there is no risk. No, man, like the risk is there. You can accept that it's there or not, or you can be okay with the risk or not. But to turn that into there's no risk, it's literally defying reality. It doesn't make sense. That's the broader point. Busy says, if you're a buy and hold and trader, it doesn't matter, in my opinion. Yeah, that's okay. Again, like if you're a buy and hold trader and you acknowledge the risk and you say, I'm okay with this risk, I want to hold Coca-Cola for 30 years, that's completely cool. There's nothing wrong with that. again, the problem I'm highlighting is a lack of objective analysis based on an internal preference. Just because I'm a buy and hold investor and I have a preference for holding things long term and I don't care if it goes down, I'm going to dollar cost average into it, which is also okay. There's nothing wrong with that. But there's something wrong with not being able to objectively realize and analyze the risk of something because of a perspective. Just because I don't mind withstanding the drawdowns doesn't mean it's not a risk. It absolutely is a risk. If I'm okay with it, then that's cool. No problem with the risk. I acknowledge it. I see it. I say it's there, and I'm okay with it. But again, the big problem is that if we're so wrapped up in our perspective of doing things that we just don't want to see the risk, that's a fucking problem. That's a giant problem. So yeah, when it comes to, I think somebody said up above, let me see. Roaring Titty says, so are you against the wheel? No way. No, I'm not against the wheel. I don't trade it. And I have a video that talks about the problems that I have with the wheel. And I will show you. This is a bit of an old video, so you'll have to forgive essentially everything about it. There you go. So that one talks about the wheel versus the covered strangle. And there's a reason why I prefer the covered strangle writ large. The punchline is I have absolutely no problem with the wheel, especially for newer traders. I actually think it's a bit of a safer, quote unquote, strategy. But I much prefer the covered strangle or ratio covered calls. Because again, going off of a definition, this is the wheel essentially. I'm going to sell cash secured puts until I'm assigned. The problem with doing that is, let's say that you're selling, let's say you like Coca-Cola and you want to trade it to the upside. And you're like, okay, I'm going to sell these cash secured puts until I'm assigned. Okay, well, guess what? You never got assigned because it just went up from here. So what's the problem with that? Sure, you absolutely would have made money. But guess what you would have made far more money with? Buying the fucking stock. So the big problem I see, exactly, G36 is right on it. I think the problem for people that trade the wheel is they get addicted to a really high win rate. They love the sensation of selling puts. They expire worthless. They love that feeling. Who doesn't? The idea of being right on a bunch of trades is awesome. There's a problem. From just, again, an objective analysis standpoint, you would have made more money doing something else. But we're too wrapped up in this great sensation of winning and feeling like we're doing this really smart thing and winning a bunch of trades that we don't really acknowledge that. So I have no fundamental issue with the wheel. If it were me, I would essentially always sell the calls at a ratio, and I would always sell additional cash secured puts. Like if I were going to trade it, which essentially turns it into the covered strangle, which is why I like that strategy a lot, personally. Reese says, also in the wheel, most people don't admit defeat and think rolling isn't losing. Yeah. Oh yeah. That's a disease. I literally showed you a post. I'll find it really quick. I showed you a post from not too long ago where I commented on something and somebody was just like, it's here. That's actually kind of funny. It's like one of my more recent posts. Here. So this says, do I lose money rolling options? And then this person says a loss if rolled for I was going to make sure I downvoted it. A loss only if rolled for a debit. And then they actually responded and then ended up taking it down. But this, it's just wrong. It doesn't matter if you roll for a credit or debit. Like, this is what a roll entails. We're closing a trade and realizing the P&L on that trade, whatever the P&L of that trade is. Positive or negative, you realize that P&L, and then you open up a new trade that's associated with it, but it doesn't get rid of the realized P&L from this other trade. It's there. It's always going to be there. But again, that's an exact thing that you'll find with a lot of wheel traders. They have such an issue accepting and dealing with losing trades. It's such a mental process for them that it completely fucks them up. That's my opinion. Dennis says, with the wheel, you're always buying higher than the market and selling lower than the market. It's a lose. Yeah, that's actually funny if you think of it that way. That's awesome. G36 says, I want Eric to be my dad. I'm not sure that you want that. I'm not sure anybody wants that, but humbled for the sentiment. But yeah, I probably wouldn't be the guy for the job. Willie says, Eric for president. I also have zero aspirations for political office. So yeah, apparently I'm just letting you guys down all over the place. Joe Tato says, was top comment accurate? Just selling the position and buying a new, farther outdated one? Let me see. Rolling options is a fancy way of selling your current position and buying. No, because you're not necessarily buying, but yeah, they're confused. But yeah, they're not wrong. It's literally just closing a trade and opening a new one. I have a bunch of videos on rolling. I'll throw a couple in here because I have a video that breaks down all of these different myths and how it actually works. So this is an older one about the myths of rolling. And then these are two new videos that I recently did that talk about more of the details about rolling. But yeah, rolling is fine. Again, like there's absolutely nothing wrong with rolling an options trade. I do it all the time. But again, the problem traders have is that in the process of doing these things, we delude ourselves and we say, oh no, it's not a loss if it's done not for a debit. Well, fun fact, you can even roll for a debit and still make money. So even that's wrong. I'll literally show you an example. If we use my little handy dandy calculator here, this is from my Excel sheet. And let's say in this, I don't even remember, we looked at this together before, AFRM or whatever. And let's say that this is the position, right? So these are the dates that we entered. This is what the stock was at. We looked at a one lot, a 30 strike. We got $1.53. We closed that for $3.45. So I literally line it out clear as day over here. So what happens over here? When I sell to open this put, I get 153 bucks. That's money that's not immediately factored. It's parked into the cash and sweep, and then it's tied to an open trade. So for example, if I sell a call, I get this $153. Your net liquidating value does not go up by $153 because it's tied to an open trade. Net liquidating values, if you closed everything right now, what can you take out of the account? So it doesn't go into net lick. It goes into cash and sweep, and it sits in cash and sweep. So then in this case, in this scenario, we bought back that option for $345. So that means that we just realized a $345 loss on this trade. The net P&L between these two trades is essentially these two numbers combined. So it's this plus this. You lost $192. That's the net. So that's essentially what this shows you here. So that's what you walk out at. After these two positions, you collected $153. At the end of it, you had to give $345 out. So you had that $153, you just gave that back, and then you had to give $192 on top of that out of your own pocket to close the position. That's the first part of a roll right there. And then the second part of the roll is when we open a new trade. So in this case, the scenario we use is we sold it for $3.50. So that means we got $3.50 times 100, 350 bucks. So now, if you take a look at all of these individual positions, you can see, so equals this plus this plus this, 158 bucks. That's how much you're up if this comes down for $0. That's what that means. Now I use a formula, as you can tell here, called the premium target, and it tells me what do I need to close this option at in order for me to hit break even. So in this case, if I sold this option for 350 bucks, I need it to be trading at $158 to be at break even for the position. So if I hit 158, I'm flat. Now, this idea of having to roll for a credit, it's wrong. You don't have to roll for a credit. So let's look at another scenario. I sold for $1.53. I closed it for $3.45. Let's say I open the next one for $3.35. That's a 10-cent debit. I can still make money. In this case, I can still make $143, even if I roll for a fucking debit. But again, people don't know this shit because they don't take the time to look into the details because they're too worried about what their ego feels about winning or losing. So I can have a trade that I roll, that I realize a loss, that I open up a new trade literally for a debit, and I can still make money. I can break all the rules here, according to a lot of these people. So this in and of itself is what rolling is. It's two trades tied together. That's all there is to it. Simple as that. So yeah, I think that the concept of rolling is super important because people literally dork it up all the time. And it's because there's so much like different like mental components that are baked into it. Tommy says, have to track the trades. Math tells the truth. That's literally exactly it. It's straight up just numbers. Now, the other thing that we have to know about rolling that's super important is that you are tying up capital. So as you're going through these positions and rolling them, you'll notice that, yeah, I can roll for a small credit and make a little bit of money. Let's grab that example back really quick. So if we just keep running through this example, and let's say that I get my 5-cent credit. So I get in for $3.50. And then let's say that I have to close this one for $4. And then let's say I can open this next one for $4.05. And then I need to include the number there. Like the amount that I stand to make on this trade is pennies. It's not much. I'm not adding a lot with each of these steps. So yes, I might be able to get out of this trade for a win, but how much money am I actually adding by rolling for that credit? In this case, I stood to make 153. Here, I rolled for a 5-cent credit. So I just added $5 to my total profit potential. And then here, I rolled for 405, got my net credit. I just added $5 to my total profit potential. How long does this whole thing take with all these rolls? There's an opportunity cost to this money. Again, people, the average trader is delusional as they think about trading because they get too wrapped up trying to avoid losing positions, and they totally fail to understand that losing is fine. Losing is completely fine. If you can learn how to be a good loser in trading, you're going to do much better than the vast majority of other people that get wrapped up with every losing position. Literally guarantee it. Because if you have a problem with losing as trading, you're going to have a lot of issues doing the right things because it includes taking losses. That's what I say. Chris says, so credit spreads. What's your typical thought for best practices for the gaps? You want to buy in the money and sell out of the money, but typically you want that trade within a day or closer to expiration. Chris, I don't actually totally follow your question, but in general, for gaps, that's kind of the point of a credit. Wait, when you say gaps, do you mean the spread width, or do you mean gap in terms of price movement with the underlying? I don't fully follow that question. Vladimir Off Putin says, how many years trading options until your aha moment, or was it gradual? Super gradual for me. I still don't feel like there's like an aha moment where it feels like you just get everything. I think it's something that you slowly pick up over time. Chris says like a 12 and 15 spread, for example. Okay, so you're talking about the width. Just so you know, Chris, when you're referring to gaps, most people, when we hear gap, we're going to think a gap in stock price like this. So, yeah, so Chris, in that sense, we would say a $3 wide. That's how we would phrase that. We wouldn't call it a gap. We would say $3 wide, or the spread is it's a $5 spread. Those are two ways, again, just so that, again, it's for beginners, right? So helping you understand some of the lingo. So for those, it's actually, I don't really trade spreads like that. I don't really like credit spreads or vertical spreads specifically. But if I were to trade them, I would try to trade them as wide as I can. And I would essentially trade it as a naked option. And then I would just use the wing for margin management if I needed it. But like for me, I'm not going to do a $5 wide credit spread. I'm essentially going to short the 70 put in this example. I might buy the 60, the 55, or the 50 if I have a small account and I need to manage the basis. But then I'm going to manage this 70 put like it's a naked short put. I'm not going to manage it like it's a credit spread personally. Now, there are times that you can put on a credit spread that are positively expectant. I have on one right now in ASTS. So for that, what I do is I measure the width and I try to find the width that gives me the best expected return. So in that example, I have a calculator. I think we went over this not too long ago that essentially helps me calculate the expected return for spreads specifically. And based on the width of the strike, the probability of profit, the credit received, those kinds of inputs, I can then decide what I need to see from the trade in order for it to be positively expectant. So that's typically what I'm targeting. Roaring Titty says, aren't they a tool for people that kind of want to park money and earn a steady income? What are we talking about? Roaring Titty? And then Vladimir Putin says, how to protect against overnight gaps down. Let's say you hold long calls and bad news is released after hours. Your primary tool is sizing. Size the trade. Roaring Titty says, okay, credit spreads. Oh, I don't think so. I think you might be talking about a box spread maybe, Roaring Titty? Because a box spread does that for you. A credit spread is a directional trade. So a credit spread, whether like if it's a put credit spread, it's essentially a bullish trade. And then if it's a call credit spread, it's essentially a bearish trade. But it's not really a place to like park your money. The trade definitely still has risk. So like, for example, if we take a look at this $5 wide credit spread in Coca-Cola, just because we're here. It's $5 wide. You collect $87 and you're risking $413. So, yeah. And then Vladimir, just so you know, my response to that really wasn't dismissive. That's the God honest truth, in my opinion, is to size the portfolio correctly and maintain a diversified portfolio. So if you have 100% of your entire, portfolio in an individual stock and you're trading long calls, that's one of the risks you expose yourself to, is essentially idiosyncratic risk, something that's very unique to that individual product. So I think sizing is probably the best possible thing you could do. After sizing, it's holding a diversified portfolio of different products. Reese says, need to collect about a third of the width of the spread to have positive expectancy. It's completely dependent on the probabilities. So it's not quite as neat as a third. For like a 30 delta, it's pretty close. I'm trying to see where I have that spread. Yeah, this one. We talked about this one. Oh, I don't know if we did this with just the Patreon folks. I don't remember when we did this one, but we talked about the spread. So this is essentially like the calculator. This one I copied over from my Excel sheet, but so like all this is broken, but this is essentially the way that I look at it. If I'm looking at a spread and I want to see if it's positively expectant from the sizing. So it's just based on essentially the different probability of profit, the width, and then the credit received. Reese says, we did an example on the dollar wide. It was 30 cents. Yeah, so it was 30 cents with a 70% probability of profit. So we need to also include the probability of profit. Yeah, it's a really important portion of the input, because if you have something that has a massively high probability of profit, then you can collect a lower credit. But that's the problem with credit spreads, is they don't tend to offer that exposure. I'm loving the questions. I think our dinner just got here, but I still got a few minutes. So, Ricky says, what if I love winning more than I love making higher profits? Yeah, then you can do that. The market can accommodate that. And there are a lot of people in the market that are not purely rational like that. So if that's what you like doing, then do whatever's right for you. But yeah, you're going to give up money doing so, which is no good. Chris says, what's your preference on time spreads? Sell shorter DTE, buy longer? It depends on what I'm trying to trade. See, this is one of the common thing traders do, right? Is we try to create rule sets about strategies. And it's not the way that I look at trading literally at all. So if I take a look at, I think I have it in here. Let me see if I can find it. No. We got all sorts of references in here at this point. No. Oh, this works. I don't know if how to learn makes sense here. Oh, I guess this makes sense. Yeah. Okay. So anyways, this is what I think makes way more sense. So for Chris, in this scenario, when I'm looking at something like time spreads, I'm not going to define the rules that I'm going to use for the time spread before I define what I'm doing. So you'll notice that if I'm trying to build a strategy, I need to think about profit mechanisms first. Then I need to figure out how I measure them. And then I can start talking about structures and strategy. So in your example, the way that I would determine what DTEs I want and how I'm going to structure the entire trade is entirely dependent on the profit mechanism. I'm not going to come into a position with the idea of like, oh, I'm just going to trade a time spread here because that's what I want. That it doesn't mean anything. I need to make money. So in order to trade something like that, I would have to start with whatever the profit mechanism is. So the profit mechanism sometimes for things like time spreads is potentially playing the relative value between options. Chris says, that's what I was hoping you would talk about, the thought process. Yeah, sure. Happy to. You know, I'm happy to. So this is less about time spreads though. And this is more about options trading. So if I take a look, we'll try Coca-Cola because it's up. Applied volatility. Let's look at the out of the monies. And let's kill this first one. Yeah, there we go. Okay, great example. So I see here at the 61, I see that the 20 SEP, it has higher vol than the 13 SEP. So I could make the relative value play that the 13 SEP 61s need to become more expensive relative to the 20 SEP. So in that scenario, I would find this exact strike, in this case, the 61s, and then I would buy and sell. So these are obviously super, super far out of the money on the put side. But again, this is just a general example. So I think these need to get more expensive, right? That's the theory, is that the 13 SEPs need to come up and the 20 SEPs need to come down. So then I'll go to the 20 SEP 61s, whatever this ends up being. Again, I don't actually know what those would be. I would do something like that. So this one's going to be obviously skewed pretty heavily, primarily because of how wide this is, but I'm just giving you an example of how to use something like that. So in this case, that's essentially the way that I could trade them for that purpose. But again, the important part is defining the profit mechanism first. How does this thing make money? And then I can start thinking about other considerations. Like in this case, how did I pick the DTE? Well, because I looked for the expirations that had something that looked interesting. I could look for ones where there's even greater inversions, or I can look for things that are in a specific direction that I want. So all of that will help me identify if I want the call side, the put side, if I want near-term DTE, long-term DTE. That's all dependent on the profit mechanism. Roaring Titty says, I don't think I passed all the prerequisites to be trading options. Don't worry, Roaring Titty. I literally think that's the same case for like essentially all of us that have ever traded options. So to me, I actually think that that makes you even more the option trader. But what I would show you is back to this little guide thing that I keep highlighting because I think it's useful. Here, I give you specific learning objectives for each of these steps that I think make sense. And then actually, if you go to the next page, you'll see that each of these, I show you like subtopics that belong to each of these that you should have a working understanding of. So eventually, I want to build like some sort of quiz or test that's built into this. I haven't figured out exactly how I want to do it. I might have to do it through like a Google sheet that then like sends the answers or something afterwards. I haven't worked out the details there. That's one of those things that's like on Eric's to-do list, but it's super low if I'm being honest with you. But I do want to build something like that. But yeah, I think it's okay to start without a full understanding, but I do think it's important to make sure that you understand what you're doing. This is actually one of the things that we offer in the Discord, even the free side, not the pay side. In the free side, you can go through these modules and you can ask people in the beginner section questions, right? Like, hey, I just finished the module 2 on the types of securities. Can somebody help me make sure I understand? And somebody typically, even if it's not me, but somebody will typically try and take a look with you. For the Patreon folks, we have a specific section where I'll go through with them, but obviously I just have limited bandwidth. I can't promise to do that with everybody, but I do my best. And the community in general will also be there to help. But yeah, I think this would add a lot of structure. That's the whole idea behind it. Chris says, HV, IV, or Greeks in thoughts at all? Yeah, I mean, they're all super important. I shared a video earlier about the Greeks. I actually have a video. I don't know. You probably haven't seen it. Let me grab this playlist for you. My guess is this playlist would be really useful for you. This is going to be an Options 101 playlist. And I have like an Options 101 video that's kind of old in there, but I still think it's good. So you can start with that. Here. So this is investing and trading 101. That's like real basics. And then this is options 101. So I would start with that second link, but in there, you'll find a link to a video that goes through the Greeks, variance risk premiums. Chris says, I know them, but mean with that spread question. Well, if you know them, playing devil's advocate here, if you know them, then you would know the answer to that question. So I would argue that you might not know them maybe as well as you think for that reason. But let's see. Like when you are doing you buy, sell. That confuses me, sorry. So time decay, gamma changing delta, yep, okay. What about them? In the meantime, I'm going to look at all these different logos on here because like this guy's funny. Maybe I can start using him if I'm mad. Like IV crushing. Yeah. I'm sorry, I'm not following your question because like in this example for the horizontal spread, that's exactly, I'm playing the volatility here. That's exactly what I'm trying to isolate. I'm trying to play the volatility in 20 sep contracting and the volatility in 13 sep expanding. Yeah. So the Greeks help us understand how a position will behave. Chris says theta crush could be wasting your time on the shorter. It could be. Yeah, there's no free lunch, right? And that's exactly to your point. That's the point of the Greeks, is because it tells us what needs to happen in order for our idea to play out. Chris says, for example, you want the IV crush for the shorter. Well, okay, so just to nitpick terminology a little bit, I think what you're trying to say here is that you're trying to structure a trade where the shorter term option you think that's where the IV contraction is going to occur. Because I would just always remind, like, the market doesn't give a fuck what you want or what anybody else wants. It doesn't matter what we want. So I'm just drawing that distinction because I would be really careful even using the terminology of like want in that instance. Chris says, so that's the goal for the shorter one. You look at all, not just... I'm trying, dog. I'm doing my absolute best to follow you, but I'm really fucking lost here. Vladimir Off Putin says, Tommy, DK effect works both ways. High performing people don't rate themselves highly. Yeah, well, that's kind of the point, though, is high people recognize their own, they recognize their own shortfalls. So the Dunning-Kruger effect doesn't persist that way for educated people. So I think this one here has something for the Dunning-Kruger effect. So there's a point where in this slope of learning phase, you know a lot more than you probably think you know, but you also know there's a lot you don't know. But there's a point that eventually comes where you do hit mastery and like, you know what you're doing, right? So in the example of trading, I can objectively analyze that there's a ton of shit that I don't know that I'm continually learning. I also know a lot of fucking shit. And I know a lot of fucking shit. And it's not because I'm cocky. I'm definitely confident because I have a demonstrated skill set over nearly 2 decades that I can look at and see, right? So I can objectively evaluate myself. So the Dunning-Kruger effect, to your point, does affect people that are in the slope of learning where they might think they know less or might judge their competence lower than it actually is. But there comes a point where right? Because even something like mastery, right? We tend to use the 10,000 hour mark for stuff like this. People don't realize how long that takes. So 10,000 hours, if you do something 5 hours every single day, Monday through Friday, Christmas, New Year's, no hungover, drunk phase, none of that. If you do that it takes 5.5 years to hit this. That's at 5 hours every single day. So the vast majority of people obviously are not going to spend this, and it takes a lot longer than that. So once you get to this point of like quote unquote mastery, you kind of know you're there because you've been doing it for a while at that point. That's my thought. Michael Anthony says, can't you know shares of a company is going by options? You can't know, but you can use them to derive inferences for sure. So the options chains can tell you a lot. I actually have a video in the queue about like reading an options chain. And essentially the goal of that video is to walk through a lot of those small things on how you can read between the lines on an options chain. And use it to help you identify information. So it's not just the idea of like how to functionally read an options chain. That's obviously part of it. But the bigger part of it is using it to try and make money by using it for some of its predictive qualities. Now, the problem with that kind of thing is a lot of people don't realize that things are relative, and you have to develop a bit of a fingerprint for whatever it is that you're looking at. So, for example, if we're looking at something like GameStop, I can tell you based on the near-term performance that today there was some really interesting price movement. I can see lots of options moving in big blocks, but then when I look in time and sales, I can see some really big trades that came through today at different points in time. So there's a lot of different ways that you can use options. You can use volatility in something like this to see like where the market thinks things are going. So in this case, I can see there's 174% vol for next week. And then the week after that's 149. And then the week before that, this was like 100 and something earlier. So why is that? It's because something's going on here. Obviously, now we know it's earnings. But if you look at some of my older videos where we didn't know earnings had shifted out, I had been pointing out this expiration cycle for a while because I could see it. It was telling me something. And my best guess, and I called it out in a video, that I thought earnings was probably going to shift because of the way that the market was pricing. So yeah, options markets are crazy, crazy informed places. You can look for all different kinds of skew. You can look for unusual trades. I have all sorts of scanners that are running all the time to help me identify interesting opportunities because of those reasons. All right, gang, it is time for me to go eat my Indian food. Absolute blast hanging out. I love the beginner session. It's so fun to dive into these kinds of things with you all. I am probably going to do a little bit of a workshop in the Discord tomorrow. I haven't figured out a time before the GameStop live stream, but there's going to be a GameStop live stream tomorrow at 5 p.m. Pacific time. We have a lot to talk about on this one. And as always, hit me up with anything you want me to cover, any suggestions, any questions, here to help. Be an outlier. Enjoy your weekends. Not too much. Get some work done. I'll see you all later.